We finish a job and we move the costs, all the costs, the labor, material, and overhead costs of that job over into the finished goods account, segregating those goods on the factory floor as being finished. And then eventually we hope to sell those goods. And when we do that, we're going to move the costs into an account for cost of goods sold. That is the reason we're accumulating these costs so carefully for inventory items, because we don't want the costs to show up on the income statement as an expense that is showing up as a cost of goods sold until we actually sell the item. If we didn't accumulate the costs and hold them as an asset, as either material, work in process, or finished goods, then they might show up on the income statement too early. Until we sell the goods, they should appear under the assets as either inventories of material, work in process, or finished goods. This brings me to another concept that I think is terribly helpful here. You may have studied this in financial accounting in a prior accounting course, and you probably talked about beginning inventory plus purchases equals the amount of goods available for sale. And you learned that you subtract from the amount available for sale the ending inventory. And that gives you cost of goods sold. So beginning inventory plus purchases is the amount available for sale minus ending inventory is equal to cost of goods sold. Now I'm going to propose a little mental trick here that I think will help help you keep track of a few terms. It may seem like a small thing, but this flow of costs here can be thought of generically for a lot of, it'd be used productively in a lot of situations. So what I'm going to propose to you is that you take two of these terms, purchases, and instead of calling it purchases, for our purposes, we're just going to call it generically costs that come into whatever we're examining at the moment. I'll show you in a second what I mean by this. And I propose that we take out the term cost of goods sold and instead think of that as sort of generically costs that are being transferred out of whatever we're examining at the moment. So beginning inventory plus whatever you bring in is what you have available. And then if you look and see what you have left, then whatever's missing must have gone out in some sense. Now, you learned this in the context of finished goods, probably if you've looked at this before. So you said beginning finished goods plus whatever came in, and if you're dealing with finished goods and you're a merchandiser as opposed to a manufacturer, then the end would have been purchases. That's how you bring new items into finished goods. You purchase them. And that's what's available. Then at the end of the time period, you could look at your ending inventory and see what you had, and whatever was missing, what went out, would have been sold. That's how it goes out of finished goods. That's how anything gets out of finished goods, it's sold. Well, this may not have occurred to you yet, but we've got a couple of processes here where this kind of flow goes on.